Hi, good afternoon, everyone.
Good afternoon.
I
Good
hope
afternoon.
my audio is clear.
Yes.
And
Yes.
if you all can hear me, just give me a thumbs up so that we can start with today's lecture. Good afternoon, Surbi. All right. So today we are going to start with risk management, and I'll just share my screen. So risk management has two parts or two topics. Today we are going to look at the first part, and tomorrow we are going to look at the second part. All right. I'm going to go through each and every page of this topic. I'm going to read it out. I'm going to share a lot of examples to make you understand the topic or the concept. If you people have any doubts, keep noting them down. Towards the end of every topic, I'll ask you people if you have any doubts, and then we can discuss your doubts. All right. So this is how we are going to go with the lecture. To begin with, we are going to study risks. And in this particular part of enterprise risk management, we are going to understand what are the various types of risks. We will understand how these risks impact our business, it impacts our operations. We are going to look at certain terms like capital adequacy, reserves, sufficient capital, and then we are also going to look at two important concepts which are very useful in the practical world, which are unexpected loss and maximum possible loss. So to begin with, guys, let's look at what is risk and what are its various types. So when we talk about risk, risk is what? It is uncertainty. It is uncertainty and generally refers to exposure to possible negative events. See, the term over here is negative events. Negative events make a possibility for risk. Risk categorization may be made broadly at strategic level, narrow at operational or transactional level. And when we talk about various types of risk, firstly, we have business risk. Now, what is business risk? Business risk is the exposure of an organization to lost profits or failures. We have a risk that the operation which we are doing, we might not get profits out of it. It is risky that we might not get profits out of it. Our business might fail. This is the risk. And this risk stems from internal weakness and external threats. So whenever we talk about the concept of business, we talk about SWOT. Strengths, weakness, opportunities, and threats. Strength and weakness is internal. Opportunity and threat is external. And when we talk about business risk stems from internal weaknesses and external threats. Business risk is broad, strategic level risk. Inefficient operations or unethical, dysfunctional leadership are risks within an organization. Regulatory burdens, pandemics, extreme acts of nature, or competition represent external risk. Let's take an example to understand this. We all have seen the era of COVID, right? Now, during COVID, there were so many businesses which got permanently out of the business. There were so many businesses which got temporarily shut down, and there were some businesses which have grown manifold, right? So, this pandemic was a threat for some businesses, and the businesses for which these were threats. Can you name any business for which COVID was a threat? Or it was a very negative event?
Tourism.
Can you name any business?
Tourism.
Transport.
Hospitality, tourism, restaurant. Yes, absolutely right. Right. So, what was the risk for hospitality or a restaurant business? That yes, people might not move out of their home to eat their food. So, should we provide them everything at their doorstep? That could have been an opportunity, right? Next, hazard. Exposure to a hazard may produce negative results. If there is no exposure to a hazard, hazard will not present a risk. Now, what is a hazard? Hazard means say for example, you people produce, wait, I'll use my, yes, maybe you people produce electronic goods. All electronic goods come with some watt capacity. Now, what product you produce, say, has a watt capacity of 1000, but it is defected. You believe that it has a watt capacity of 1000, but no, at 1000 there is a spark. This is a hazard, and this will result in risk. What would be the risk? Maybe some customer will get a shock, and due to this you have to meet some financial obligations. So hazard itself is not a risk, but yes, eventually it becomes a risk. Next, financial risk. And this is something that every business fears. What is financial risk? Is it just the loss of profit? No. Financial risk talks about capitalization. It talks about from where will I source the fund to run my operations. Then it has risk related to transaction execution and settlement. Say, for example, you are in a business of import-export. You are in India and your supplier is in USA. You import raw material from USA. And after 10 days, you have to make a payment in dollars. Now, if you do not have sufficient funds in your pocket, in your bank, in your reserves, then it is a financial risk that this transaction which took place will not be settled timely, due to which you will lose credibility, due to which you might have to incur some interest and penalties. That is financial risk, not the loss of profit. Next is strategic risk. When we talk about strategic risk, we say that what all planning, what all plotting, what all strategies we have made while budgeting our year, while budgeting our financial year, they might fail. So what is a strategic risk? Strategic risk is that outside threats in the industry might make my strategies fail, due to which my business will not operate as I wanted it to. There might be situations that you are predicting there would be boom in the industry, but due to some regulations, due to some laws, due to some decisions at government level, there is no expansion. Let's take an example to understand this. Let's not go far in time. Let's just go in the era of COVID. During COVID, our government decided that we will ban China, right? We are not going to buy anything from China. Now imagine you are a supplier or you are a trader of hardware goods, and maximum of your material is imported from China. Your industry is doing very well. COVID hit, government banned China, and now you are thinking that what will happen to my business? How am I going to source cheap material, add in my profit margin, and sell at competitive rates? Now, all such things are giving rise to strategic risk. Next is operational risk. Now, see, as the name suggests, operational risk. What is operational risk? Operational risk means risk that your day-to-day operations will not be met. What are day-to-day operations? Day-to-day operation, let's take an example. Say, this is your factory, and in your factory, 100 labor are working. There are 10 machines. And this 100 labor and 10 machine has a production capacity of 1 lakh units. Okay. Now, what could be an operational risk? The operational risk could be these machines are not working at their full capacity. There is breakdown of machine, due to which these 100 labor are sitting idle. Now, the time in which they could have produced these units, they are simply sitting idle. And that is cost for you, because you can't tell your labor that the machines are not working, therefore I'm not going to pay you. They will say, we are here to work. If the machine is not working, it is not our problem. You need to pay us. And mostly in factories, we have daily wagers, right? So we need to pay them on daily basis. On the basis of hours they are in the factory. So if the machine will break down, there is an operational risk that you will have to bear a cost for the idle time of labor. Fine. So that is operational risk. Now, operational risk is characterized by inefficiency and ineffective delivery of value. Just give me a moment. I think someone else is also using this ID. By the time this is loading, let me take you to my charts so that our time is not wasted. So I have summarized all the risks here. We have done business risk, we have discussed financial, strategic, and operational. Now we are going to look at legal risk. What is legal risk? Legal risk is that there might be some default in your product, some breach of contract with your suppliers or customers, due to which you have to face legal actions, legal obligations. Say, for example, failure to adapt changes in the law. Let's take an example over here. You are in cement or paint industry. Let's take paint industry. Suppose the GST rate on paint industry was 12%, and now the government has changed it to 18%. And your accountant missed on this. And you have been filing wrong GST returns, due to which now you have to bear interest and penalty. This is legal risk. Next, compliance. Again, compliances are mainly through government. Say, for example, your business has to comply with better working conditions. Say, for example, in the area where your factory is there it is extremely hot weather, extreme hot weather, and your factory has to meet some ground rules for welfare of the labor, but you have not made correct provisions for water, hygiene, sanitation, maybe air conditioning is not good. So all these things are not as per the compliances. And due to this, you might have to bear some fines and penalties. And that will be your compliance risk. Next is political. Again, political risk. As I told you, political risk comes from changes in law. It comes from changes in law. Say, for example, your factory is in special economic zone, and government has changed the time period of tax holiday from 5 to 3 years. So 2 years tax holiday has been reduced. This is what? This is a risk from changes in the law. Next, inherent. See now, inherent risk and residual risk are really important for us to understand. Why? Because all other risks can be resolved, can be managed. But inherent risk is one such risk that comes in the absence of direct and focused action of the management. If management does not have a direct, focused action towards the business, towards its loopholes, then there would be inherent risk that we need to bear. And second is residual risk. This is very dangerous. Why is it very dangerous? Because even after implementing all the responses, all the cautious precautions, still there is some kind of risk that we need to bear. And that is known as residual risk. So residual risk is when there are focused actions, there is direct action, still risk persists. And inherent risk is when there is absence of direct and focused actions by the management. Right? Next. Just let me check if CMA login is working. So we have seen various types of risks. And in case you have any doubt in these various types of risks, please ask me. Else, I'll move ahead to the next topic, which is risk assessment.
Can you please give an example of the last two?
Does
Inherent
anyone
and...
has any doubt in the types of risks?
Hello?
Let me quickly take you through the summary of these. First is business risk, wherein we look at loss of profits. This is due to internal weakness and external threat. Secondly, we have financial risk. Financial risk is related to business capitalization, transaction execution, and settlement. Third is strategic risk, wherein the external events prevent the organization, prevent the business to apply its own strategies. Next is operational, wherein human error, exposure in day-to-day operations. Legal is failure to adopt changes in the law, defective products, and breach of contract. Compliance is risk of sanction, fines, and judgments. Political, increase corporate tax, decrease profitability. Inherent is when management has taken no action, and residual is after taking all possible actions, still the risk persists. Fine? Can you please give example of inherent and residual risk? Right. I can give you an example of inherent and residual risk. Let's go back to our notes and look at this example number 1. A company seeks to mitigate exposure to storm damage to the windows of a factory located in a hurricane zone. The company debates the merits of storm shutters. I think someone is using the login. All right, I hope you people have your books right. So please open up your books. And we are going to look at this example from our notes. Let's read it together, everyone. A company seeks to mitigate exposure to storm damage to the windows of a factory located in a hurricane zone. The company debates the merits of storm shutters and impact-resistant glass, and based on both cost and perceived risks, elects for impact-resistant glass. Shashank, I can share the screen, but the problem is that the CMA login, which I have, is being logged out again and again. I will take up this matter with the technical team at Simandhar during the break time. Right now, I don't want to waste the time. I don't want to break the flow of the class. Therefore, it's my request, everyone, let's read from the book. And when we'll take a break, I will raise this matter to the Simandhar team and I'll get it sorted. Is it cool with everyone? I really don't want to break the flow of the class. The class is going really good. So let's utilize our full energies and efficiency. Okay, coming back to the example. So in this example, what is happening? there is a factory located in a hurricane zone, and due to storms, what is happening, we are anticipating that there would be damage to the factory. So to mitigate this risk, what is the company thinking to do is that they will use some storm shutters and impact resistant glasses. And when they are taking this decision, they are also looking at the costing of it, right? And they have properly installed impact resistant glasses, but still there is some risk that these glasses might also fail to protect our factory. So what is happening? Inherent risk will be when there is no decision taken by the board, which means if we are in the hurricane zone and the board says this is a natural calamity, what can we do? We cannot, spend so much of money, we are short of cash. That will be inherent risk, that we are not doing anything for it. It is inherent risk. But in our example, the board has decided that we are going to use storm shutters and impact resistant glasses, right? So they have taken direct and focused action to face that risk, to mitigate that risk, to reduce that risk. But still, the glass is vulnerable. If there will be a very a big storm or a very strong storm, these glasses may also splatter, and that will be known as residual risk. Okay, so the risk that the company will have to replace the windows after installing impact resistant glass is the residual risk. Got it? Shubham Verma, have you understood?
Yeah, clear.
All right. So now we are going to look at second topic, which is risk assessment. And for that, I will share my screen. I also want you people to keep your books open. Let's look at risk assessment. See, when we talk about risk assessment, what we are doing? First of all, we have understood what are the various types of risks, right? Now we need to see which risk is related to my business. Then we have to analyze that what impact this risk is going to have financially on my business in the terms of money, right? So under the topic of risk assessment, firstly, we need to look at the factors that impact risk. Investors are compensated for risk by rates of return. See, why do we have to do all these things? Jepal, firstly, from next time, please be in time. Secondly, we are looking at risk assessment, which is Unit 4, page 6. Looking at risk assessment. We have just started with risk assessment. All right, now I'm not going to look at the chat box. I'll look at the chat box after risk assessment topic. Okay. Now risk assessment, guys. Risk assessment, as I was telling you, that why do we need to do this? What is the need of this activity? See, whenever we are doing some business, someone or the other has invested in our business. None of us want to ruin our savings, right? We always take money from some financial institution, from some bank, or from some friend or relative. And from that money, we do the business. Now, if a person is investing in our business, they will want something in return, right? And whatever they will get in return is directly proportionate to the risk. Because if the situation, if your business is volatile, then there is a probability, there is a high chance of risk. And if there is a high chance of risk, then everyone will want to get better and high returns. So we say that investors are compensated for risk by rates of return. Risk may be quantified as a rate of return and expressed as rate of return or with volatility calculation. Now, what is volatility? Volatility is a measure of the likely effect of change in the expected rate of return on. Just give me a moment. I'm talking to Simandhar's team. For example, someone has invested 10 lakh rupees in your business, right? Now, what will happen? If I have invested 10 lakh rupees in your business. I will want something in return. And what is something in return? I will definitely want these 10 lakh rupees back, right? Plus, I will want something extra on these 10 lakh rupees. Why? Because if I would not have given you this money, I would have used it somewhere else. Maybe I would have invested it in some shares, in some mutual fund, from where I might get 20% return. So I'll tell you, okay, fine, take 10 lakh rupees, but I need my money back. Plus, I need 20% extra on it. Right? So this is the return that I will want on my money. Because the 10 lakh rupee which you will return me is the money that I gave you. It is not something extra over and above what I gave you. So my return would be this 20%. This will be my rate of return. Now, this rate of return is directly related to the financial health of your business. It is related to the financial health of your business. So, if your business is volatile, which means it is risky, then I will want a higher rate of return. And anyone will do this, right? So, the concept of volatility talks about this only. The greater the time a security is outstanding, the greater the chance that the expected rate of return will change, thereby changing the value of security. Say, for example, I take money for 10 years. I think there is some internet issue at my place. I don't know what is the issue, but the Wi-Fi is blinking red. Yes, I'm having internet. Please be calm. Thank you for your kindness, everyone, and patience. But if there is some internet issue, I hope and I pray to God that no more issue is there of internet and our class moves on smoothly. What is the issue with the internet? Guys, please check what is the issue. Okay. All right, everyone. So we were talking about this passkey. See, the greater the time a security is outstanding, the greater the chance that the expected rate of return will change. Now let's try to understand this. See, I said that I have given you 10 lakh rupees. Maybe I have given you these 10 lakh rupees for 2 years. What is the probability that your business will be volatile during this 2 years? Versus what is the probability that your business will be volatile for a period of 5 years? Naturally, the longer the period, the volatility will be more. Therefore, we say that whenever we invest for longer period of time, volatility increases, risk increases, and the change in rate of return increases, due to which the value of security increases, or the probability that there would be change in value of security will increase. So, keeping this thing in mind, we will talk about profitability and expected loss. But before that, I want you people to underline a few things alongside. First, please underline these 3 lines. Very important. Long-term investments may decline in value. They may decline in value because of changes in interest rate, default, or from erosion of purchasing power from inflation. Longer time horizons increase exposure to changes in interest rates, impact of inflation, and risk of default. Due to which, what will happen? The volatility will increase. Now you'll ask me, ma'am, how will this happen? Please take an example and explain. So let's take an example to understand this. Say, for example, you have invested today 10 lakh rupees. Okay. And 5 years from now, 5 years later, this 10 lakh will change its value because of time value of money. And this time value of money is directly proportionate to interest rates in the market. It is directly proportionate to inflation in the market. So time value of money is something that will change the value of this 10 lakh. This 10 lakh might fetch you 20 lakh. This 10 lakh might fetch you 8 lakh. Depending on what is the economic condition after 5 years. Right? Now, talking about probability and expected loss. Expected loss due to risk can be computed as weighted average of a range of outcomes and their associated probability of occurrence. Now, to understand this, let's look at illustration number 3. The X company is evaluating its overall expected loss, based upon risk associated with its international operations. The company faces the risk of loss of business value from a variety of sources, including all strategic risk, legal risk of operating internationally, compliance risk, etc. Global participation also increases strategic risk from natural disasters. Now, what has happened? Let's look. These are the types of risks which we are anticipating, right? One is strategic risk, political risk, legal risk, and compliance risk. Let's look at the exposures. Natural disaster, technical obsolescence. Under political, we have 2. Under legal, again, we have 2. And under compliance, we have 2 more. The probability that this risk will mature, it is the probability that the risk will mature. 15%, 5, 0.1, 5, 5, 4, 2, and 0.1. And this is the loss which we are anticipating. We are anticipating that this would be the amount of loss that we will have to face. So what is the expected loss? The expected loss is probability of loss into the anticipated amount of loss. Probability into the anticipated amount. And then we will get our total expected loss. Now, this total expected loss is something that we need to try to mitigate. And to mitigate, we might use some mitigation theories for these risk exposures. Say, for example, to mitigate failure to adapt to foreign laws, we might hire some lawyers, some subject matters, some subject experts, not subject matters. Then these lawyers can keep an eye on the laws, which are applicable to my business. What do you mean by technological obsolescence? By technological obsolescence, we mean that the technology that we are using in our factory is outdated. I'll give you a real life example in this. I'll share my own real life example with you people over here. So as you know that I'm a chartered accountant, right? What happened was, when I was training during my articleship back in 2008, we used to use Tally as a software for accounting. So my principal, I'm based out in Chandigarh. It's in North India, near Punjab. So my principal, in my principal's office, they used to use Tally for accounting. And they used to use Computex for filing returns. These were the 2 softwares which they used to use, right? So this was the technology that was very much trending in 2008. By the time I became a chartered accountant, these were outdated. See, I got the training of Tally, I got the training of Computex, but 6 years, 8 years down the line, by the time I became a chartered accountant, guys, trust me, what happened was these two softwares were outdated, and I felt handicapped. What would I do now? The softwares which I expertise, the softwares which I master, they are out of the market. No one uses them. This is known as technological obsolescence. When you use outdated technology. The same thing happens in factories. Maybe you are using a machine which takes 5 years to produce 10 lakh units. And in the market, there is a new machine which takes 3 years to produce 10 lakh units. What will be beneficial for you? Definitely this machine. Why? Because if you will produce fast, you can sell fast and you can earn fast. So got the answer? Rakesh, this is also an example for business. See, if as a professional, if as a chartered accountant, I will use the softwares which are outdated, that is going to affect my efficiency to work. How will it affect my efficiency to work? Say, for example, I'm still using Computex, right? And Computex can't work without Internet Explorer. And you know that these days, Internet Explorer, no one uses. It is the world of Chrome. So I'm using a software which is backed by a software which is outdated. This is going to affect my efficiency to work. It might take me 1 day to file one return due to slow processes of these systems. And on the other hand, my brother, who is also a chartered accountant, uses a later software wherein he can file 20 returns 1 day. So who has the capacity to entertain more clients? Definitely my brother. Therefore, all these things, even if they are for your personal growth, they are eventually going to affect your business, Rakesh. Okay? So, would you kindly explain all the risk exposure? It will help to understand this. Would you kindly explain all the risk exposure? All right, I will explain all the... You want me to give the... Neeraj, do you want me to give the example of all the risk exposures in this example?
Yes, yes. So it would be really very helpful while we are studying on this part. It's just a short example also, but it will work
All
for
right.
all of.
So as regards natural disasters concerned, COVID is the best example. It is a natural disaster. Hurricane, cyclones, these are natural disasters which definitely disrupt your working. How? Say, for example, I am in North India. My raw material comes from South India. And there is a cyclone in South India. Due to which what will happen? Due to which the supply chain of my raw material will be disrupted. What is supply chain? The transport system. The goods cannot be loaded in the good transport vehicle, the trucks, and these trucks cannot reach North India or my factory in time. Therefore, what will happen? Usually in normal days, if this raw material reaches me in 7 days, now it will take 15 days. This 7 days lag, beta, this 7 days lag is going to hamper my productivity. I will not be able to meet orders in time, and that is going to affect my business. That is the risk. Technological obsolescence is something that we have. Right, Surbi, you may call it an act of God, but the act of God is hampering our business. All right. Next is technological obsolescence that we have already discussed. Then we have tariffs. Do you know what is tariff? Does anyone know the meaning of the term tariff? Rates. What rates? What rate? Taxes levied, customs. Exactly. Exactly. So, tariff, the example that I gave you of GST. Say, for example, on automobiles, the GST used to be 18% and now it has been made 28%. What will happen? What will happen? This decision of the government will make your final product expensive for the consumers. And once your product will become expensive for the consumers, guys, tell me, are the consumers going to buy your product? The sales will drop down and that will affect your business. Then we have this term, expropriation of assets. What does this mean? Does someone know what does this mean? Can someone tell me what does this mean? Okay, let's take an example. Yes, government seizure. Why? Because they want to bring in some social welfare activity. Say, for example, I am a farmer, right? And this is my piece of land. Now, the government wants to make a national highway on this piece of land. And the government says that we are going to buy this much piece of land from you. What will happen? This will reduce my chance to earn. This will reduce my chance to earn. Had this been my property, I would have grown more crops and could have sold more crops and could have earned more money. But now the government has taken this this land from me to make road. I know that the government is going to compensate me. I know that the government will compensate me for this. But this compensation is one time, which might be less than the amount of money which I would have earned by growing crops here. So this is the risk. Many a times it happens. Government says that we will stretch the road. Then what will happen? The shops nearby will have to give up their land. This one was one of the reasons for automobile recession. Absolutely, Shashank. Absolutely correct. You know, all such things will make us better professionals. You people are going to become CMAs, right? Management accountants. And the way industry is moving, you know, people want to discuss their businesses with professionals. They want to know how they can reduce the risk, how they can increase profits, how they can, you know, improve the reporting of their business, how they can work within the ambit of the government and the law, you know, peacefully. So all such things are really important for us to think out of the box so that we can guide our clients, we can consult our clients effectively. Okay, moving ahead, theft of intellectual property. So this is like theft of your formula. It happens mostly in pharmaceutical companies. Failure to adapt to foreign laws, like say in India, I'm a real estate, I'm into real estate business, right? And in India, in real estate, say capital gains have 20% rate taxation. But in USA, maybe there are some exemptions, which I missed out, due to which I paid more tax. So this is failure to understand or adapt to the laws. Then fines levied for not complying with the law. Court ordered cease and desist. Court has said that the product which you are making is not environment friendly. So you have to stop the production of that product. What will you do? You will have to abide with the law. And then you are with the machinery, your sunk cost, the cost which you cannot recover anymore because you have to stop the production. So this is a big risk that your business might be stopped. All right, Neeraj, I hope I have explained all these terms written here. These are clear with you?
Yes, yes, thank
These are
you.
clear to you, Neeraj?
Yes, thank you.
All right, guys, moving ahead. See, now if we talk about unexpected loss and maximum possible loss, this is something which is going to help you in many ways. Now, what do we mean by these two terms? It is very important for us to understand. See, maximum possible loss is the worst loss that could occur from a single event. See, the term says maximum. So this will be the maximum loss that could happen, right? The maximum possible loss is the sum of expected losses, unexpected losses, catastrophic losses, where catastrophic losses are financed by insurance. Say, for example, let's take an example to understand these three terms. Okay. Say you are in the business of automobile. Government said that the GST would be increased from 18 to 28%. Now, what will be your expected loss? Can someone give me an example? What will be your expected loss? Your expected loss would be that the demand might fall. And the CFO of your company and all the chartered accountants, the CPAs, the CMAs have worked that the demand might fall by 10%. This is the expected loss which you are expecting. Can someone tell me what could be the unexpected loss? The unexpected loss can be loss of supplier or loss of credit worthiness with the supplier. What is the credit worthiness? Say, for example, I am the owner of Honda and I buy tires from MRF. Now, when Honda became expensive due to 28% levy of tax, MRF stopped giving me 25 days credit. They said, we will give you only 15 days credit. What does this mean? Which means, first, if I used to buy 10 lakh rupee tire from MRF, they used to give me 25 days to pay this 10 lakh rupees. But now they have said, we will only give you 15 days credit. What has happened? I know that demand has fallen. So the sales will come in slow. And over here, the outflow has become fast. So money will come in slowly, but money will go out fast. This is going to create the problem of liquidity for me. So this was what I was expecting, but this was not what I was expecting, right? Such things. This is expected loss and this is your unexpected loss. And what is catastrophe loss? Catastrophe loss is something which is a part of unexpected loss, but you can insurance it. Say, for example, you have your fire insurance, you have your accidental insurances, all those things are unexpected, but still you can anticipate them and you can have some insurance policies in house to reduce the effect of the risk if it matures. Understood? Everyone? Guys, if you have understood what I have explained to you till now, give me a thumbs up. What happens is I become very emotional while teaching or while discussing the topics. So I just keep on going on without realizing that my speed is increasing. My speed of speaking is increasing. So if anyone wants me to slow down, you can tell me right now. And if the speed is fine, just give me a thumbs up. If you have understood everything, give me a thumbs up. I'll continue. All right. Thank you so much. Let's continue with the topic. Let's continue with discussing the topic. Now, oh God, don't tell me this will log out. Okay. By the time this is logging in again, is it logging in? Yay, it's logging in. Okay. So guys, next paragraph, let's read it carefully. See, why am I reading the entire line and passage with you is because the concept clarity is the key. That is our goal. I want each and every one of you should has concept clarity so that whenever you are solving a question, whenever you are reading a question, whether you are practicing, whether you are solving a mock test, or whether you are in the examination, the concept is clear. And I'm sure if the concept will be clear, you will be able to answer the questions. So let's quickly read it. Expected losses for financial assets are the average credit loss anticipated from the exposure over a given time, right? So this is expected loss. As I told you, reduction in the demand. Now, what is unexpected loss? It is average total loss over and above the expected loss. Something which I have not anticipated, right? Now, unexpected loss for financial asset is computed as difference between value at risk and expected loss. So I'll quickly take you to a beautiful chart that I made for all of you to understand this concept. See, a bit of what we have studied. We have studied that if the time the security outstanding is more, volatility will be more. Therefore, probability that the rate of return will change will increase. All these will increase the risk. That will again increase your loss, which means the chances of loss. Now, the losses are of three types: expected, unexpected, and catastrophic. Expected losses are something which you have budgeted for, right? Catastrophic losses are something which you have insured. And unexpected losses are value at risk minus expected loss. You know what is expected loss. Let's understand what is value at risk. Now, when we talk about value at risk, it is to quantify the worst case scenario, to quantify that what can be the maximum loss that my business can face, right? So to quantify, we use three methods. One is historical, second is variance-covariance, and third is Monte Carlo simulation. Guys, whenever we talk about historical, we always look at what has happened in the past. So when we talk about historical, we look at severity and frequency of loss that has already happened, and we are thinking, or we are anticipating that it will be repeated. Second is variance-covariance. When we talk about variance-covariance, we always look at statistical measure of standard deviation. Statistical measure of standard deviation and average. We look at average return, we look at the standard deviation, and we try to form a tolerance range, a confidence level. It can be yearly, it can be quarterly, it can be monthly, or it can also be daily, right? So variance-covariance is nothing but a statistical measure to quantify how much loss can happen. And Monte Carlo simulation, it generates projections. How does it generate projection? By taking hypothetical scenarios. By taking hypothetical scenarios. When we take hypothetical scenarios, then we are looking at the downside. What is downside? Downside means negative events of the economy. Something which will be a threat to me, not an opportunity for me, because we are talking about risk. So when we talk about risk, we talk about downside. Downside means negative events which results in losses. So if we have to read it in detail, we say that value at risk is used to quantify. It is used to quantify worst case scenario for losses that will be incurred as a result of market volatility. Now, this can be, looked at in 3 levels or with 3 variables. One is confidence level, second is period, and third is amount. When we talk about the confidence level, what we need to remember from examination perspective, confidence level will be 95 to 99%. Why? Because we are looking at worst case. Worst case is maximum. When we are looking at maximum, then we will look at 95 to 99% of the probability. And this can be yearly, quarterly, monthly, daily. It can be calculated for any time period, right? And to calculate it, we have 3 methods. One is historical, second is variance-covariance, and third is Monte Carlo. And historical is past returns. And we look at the frequency and severity of our past losses. Variance-covariance method is a statistical approach wherein we look at average return and standard deviation from that. And Monte Carlo is nothing but hypothetical projections. All right. Can we say unexpected loss is difference between maximum loss and expected loss? Yes, we can. Pratishta, we can say that. Shiv Singh, the batch has started today. There was an orientation class on 10th of February. It is the first class today, and we have started with risk management. Good morning. Okay. All right. So guys, I hope this much is clear, right? Now we will move to another interesting part of this topic, which is qualitative risk assessment tools. See, till now what we have studied, let's quickly make a roadmap of the chapter in our heads. Firstly, we understood types of risks. Then we understood how to assess them. Now to assess them, firstly, we need to see what impact will they have on us. Okay, na? So secondly, what we did was we saw impact of risk. And now we are going to look at the assessment. When we talk about assessment, we have 2 types or 2 methods. First is qualitative assessment and another is quantitative assessment. Qualitative assessment and quantitative assessment. J, Monte Carlo simulation is projection. Okay, now do you understand what is a projection? Okay, let me give you a simple basic example. When we start a business, we take loan from bank. And every bank says, give us your projections for next 3 years. These projections are based on some variables. Variables like, we always look at, because over here, we are not looking at the downside, we are looking at the positive side. So we will look at everything good, that the demand will increase. Our production capacity will increase. Therefore, our supply will increase. If our supply will increase, our sales will increase. Sales will increase, profits will increase. And therefore, our capacity to pay back the money to bank will also improve. These are the positive projections. We can look at the negative projections as well. Let's take the same example of automobile industry. Guys, automobile industry, 18% has been struck off and we came in the bracket of 28% of tax. Now, what can be the negative projections? Negative projections, demand will decrease, supply will decrease, there will be liquidity crunch, there would be aged creditors, there would be aged debtors, there would be more probability that our credit worthiness will reduce. And all these things are negative sides. So when we look at all such things and we try to get to a number that how much we can still, do the business, number, that how much we can do the business. That is your projection. So this is your Monte Carlo simulation, wherein we look at the variables and then we see that how low can we fall. All right, Jay? Cool. Okay. So if we have to look at the summary charts, we have seen this chart, we have seen this chart. Now we are going to look at this chart. We are going to talk about qualitative risk assessment tools. And when we talk about qualitative risk assessment tool, first, we are going to look at how we are going to identify the risk, that risk ranking, and thirdly, risk mapping. Now, when we talk about risk identification, we have 5 methods. One is risk inventory. Second is facilitated workshops. Third is interview. Fourth, questionnaire and surveys. And fifth is process flow analysis. Process flow analysis. When we talk about risk ranking, over here we are ranking the risk based on 2 things. One is your probability and second is your potential impact. When we talk about probability, we are saying low, moderate, or high. When we are talking about potential impact, we are looking at insignificant, moderate, significant, and catastrophic. And lastly, we have risk mapping. Risk mapping is nothing but graphical representation of risk ranking. In this, we make 2 types of maps. One is heat map and another is a matrix. Both these things represents overall expected likelihood and impact of risk.
Excuse me, ma'am.
Madam, sorry to stop you. But
what we are
can't see
doing
the
over here,
screen.
we are trying to assess the risk, right? So to assess the risk, we will look at what is the likelihood of risk, which means what are the chances of risk to mature and what will be the impact of this risk. Monetary? No. We are talking about qualitative, so we are going to look at the impact which is high or low. Yes, Dilesh, you raised the hand.
Yeah, actually, we don't see the screen, ma'am.
Freezed?
It's freeze, I think so.
Why is the screen frozen? Can you see this chart? Qualitative
No.
risk assessment.
Now we can see. Now we
chart.
can see.
Can you see
Now we can
my
see.
handwritten chart?
Now it's visible to us. Earlier it was not.
Okay. I'll repeat the chart if it is now visible. See, when we talk about qualitative risk assessment tools, guys. No, my speaker is not muted. Previous handwritten chart was not visible. Was this chart not visible to you people?
Yeah, we cannot see previously.
I don't know, this must be some technical glitch, guys. Still you cannot see the chart?
We can see now.
Can you see the chart?
Yes.
Yes, we can
All
see
right.
now.
Yes, you can see. So I'm repeating it. I'm repeating the chart. Okay, when we talk about qualitative risk assessment tools, guys, we have 3 things that we need to focus on. One is risk identification, second is risk ranking, and third is risk mapping. When we talk about risk identification, there are 5 things: risk inventories, facilitated workshops, interviews, questionnaires and surveys, and process flow analysis. When we talk about risk ranking, we are talking about ranking the risk on the basis of probability and potential impact. On the basis of probability and potential impact. And when we are talking about risk mapping, we say that risk mapping is nothing but graphical presentation of risk ranking, wherein we make 2 types of maps. One is heat map and another is matrix, which tells us about the likelihood and impact of risk. Likelihood of risk means chances that the risk will mature. And impact of risk means that whether this risk will impact our business high or will have low impact on the business. In this case, we do not compute the impact numerically. Why? Because we are talking about qualitative methods. When we will talk about quantitative methods, at that time, we will look at the numerical value of the risk, or you can say the amount of risk. But when we are talking about qualitative, we will only talk about its impact to be high or low and not in terms of rupees or amount. Got it? If it's clear with everyone, can you please share the example? Sneha, I am going to dive into these two topics deeply. We are going to look at the examples given in our notes. Don't worry, we are going to discuss each and everything. But before that, we will take 15 minutes break and we are going to resume the session at 2:30. The reason for this is that the battery of my laptop is drained out. It needs a bit of charging. You people also take water break, have some fruits, have your lunch and come back. But have light lunch so that you are alert and awake when I'm talking. All right. So I'll see you all in 15 minutes. I'm not ending this meeting. This meeting will stay as it is. And I will come after 15 minutes. Exactly at 2:30. Yes, I will share my handwritten charts with you people. I will share it with Team Simandhar and they can put it up on your LMS. All right. So let's continue discussing qualitative risk assessment tools. And we are going to read it out from our notes. So I'm sharing the screen. Can you see the notes? All right. So when we talk about qualitative risk assessment tools, what we need to remember is that under this technique, we assess the likelihood.
Priyanka, your notes
Under
are
this
still not
technique,
visible.
we assess the likelihood and impact of risk. And over here, what we are going to look at is we are going to look at 5 techniques.
Ma'am,
You
your
can't see
notes
the
is not
screen?
visible.
No, I'm not sharing my own notes. I'm reading out from the book. Can you see?
Yeah, we can see your book.
All right. So the first one is risk identification. When we talk about risk identification, we look at the variables or the events in the industry, in the economy, through which we can understand that yes, this particular thing is a risk or a threat. Say, for example, you are in real estate sector and you have to build the societies. So if you are building on agricultural land, the risk is that there would be a lot of wet walls, there would be a lot of breakout in the walls, no damp walls of your society. So this is one event that you have identified. So this way what happens is every industry marks out what events are the risk for their businesses and they form a list out of it. And that list is known as risk inventories. Next, to form this list of risk inventories, what happens is most of the time, many players of the same industry meet up and discuss the issues. Say, for example, can you see what I'm writing? Yes. Say, for example, many players of automobile industry like Suzuki, Honda, Hyundai, Toyota, all these players meet up and discuss what are the risks due to increase in GST rate. When they will discuss these risks, they will list down. And then risk inventories will be formed. So risk inventories and facilitated workshops are interrelated. Over here, we try to discuss what are the problems that we are facing to do the business. Then we have interviews. Under interviews, we do not do group talking. We do one-on-one talking. Like in facilitated workshops, we are looking at collective knowledge. We meet, we form groups, we talk. But under interview, the same thing happens one-on-one. Then there is questionnaire and surveys. Now, what are questionnaires? Okay. Have you ever eaten in a restaurant and along with the bill, there came a feedback form? Right? So this feedback form is a method to take feedback, to take count of what the customer liked. One-on-one with whom, Neeraj? It can be with anyone. It can be with the market leader. It can be with the advertising team. It can be with the marketing team of various automobile players. So instead of everyone grouping together, meeting together, there are committees formed and then they talk to everyone one-on-one. And when we talk about questionnaires and surveys, over here, what is happening is that there is a set format, a questionnaire. There are certain questions and everyone has to answer this question. And after these questions have been answered, these have been surveyed, analyzed, and summarized to understand that what are the issues that everyone is facing. And lastly, we have process flow analysis. Under process flow analysis, we look at flow charting. Basically, what all information we have gained in the above 4 methods are now put into a flow chart, wherein we look at what are the inputs, what are the tasks, and what are the outputs that we are going to get out of it. So these are the methods to identify the risk. After that, we have risk ranking. And when we talk about risk ranking, we are talking about probability of risk and potential impact of the risk. Again, probability is nothing but likelihood. So probability is a measure of how likely it is that the risk will occur. In evaluating risk to technology system, for example, a terrorist attack on the system might be assigned a very low level of probability, while the presence of hackers might be more likely, right? And companies' technology for personal use might be highly likely. So when we talk about probability, we are talking about very low, moderate, or very high. Then second leg is potential impact. When we talk about potential impact, we categorize it into significant, insignificant, moderate, and catastrophic. Now, anything which will have minimum loss will be insignificant. And anything which will be catastrophic will have maximum loss. That is why we want such events to be insured. Then we have risk map. Risk map is graphic representation of risk ranking, right? And over here also we are going to talk about two things. One would be the likelihood and another would be the impact. What is important for us to understand is that risk map can be a heat map or a matrix. Now, what is a heat map or what is a matrix? Let's try to understand with this example. Now, under the heat map, what will happen? We are going to color. We are going to use the color. Like if you will see the likelihood, if it is unlikely, it is light color. And if it is high, it is dark color. So what will happen when you are going to look at this analysis? Immediately your focus will go on emerging technology and market competitiveness. Why? Because these are very dark colored. So you will immediately get a feel of it that yes, these are the two risks which are highly likely to be possible and they have high impact also. So these are the two things that need to be mitigated or reduced immediately. Right? And if the same thing has to be done in a matrix, what will happen? Under a matrix, always on x-axis there will be likelihood and on y-axis there will be impact. We can say that likelihood is always horizontal and impact is always vertically shown. So over here also they have used colors, and the most dark one is B and E. And what is B? Emerging technology and market competitiveness. Again the same. So the focus is that firstly we need to target these two things, and after that moderate ones, which are A, C and D, which is shift in lifestyle, labor shortage and political environment. And the least unlikely thing is expanding role of big data, which is F. So basically in less words or in no words, we are trying to tell our authorities that, see, these are the two things that we need to focus on and immediately work on. So if you will observe over here, we are not talking about money. Over here, we are not talking about the cost benefit analysis. No, we are not talking about all those things. If we need to talk about money and cost benefit analysis, then we will have to move towards the quantitative risk assessment tools. And when we talk about quantitative risk assessment tools, we always talk about three things. One is your cash flow at risk. Can you see my handwritten charts?
Yes, we can.
All right. So first one is your cash flow at risk. Second is earnings at risk. And third is earning distribution. We are talking about quantitative risk assessment tools, wherein now we are going to look at the numbers. Cash flow at risk means that organization changes in cash flow relative to target cash flow expected over a defined time horizon. Say, for example, you have invested in a machine today, 0 time period, say 10 lakh rupees. And the life of this machine is 5 years. You are expecting that within the period of 5 years, this machine will help me to earn 50 lakh rupees. So this is the target cash flow. Cash inflow, I must say. On today's 10 lakh cash outflow. Cash flow at risk means that you are not going to earn 50 lakh rupees. The inflow will not be 50 lakh. This will be your cash flow at risk. When we talk about earnings at risk, we look at accounting income, which may change due to change in interest rates. And when we talk about earning distribution, we always look at paying back to the investors. Paying back to the investors. And how do the investors get confidence in your business? When the stock prices of your business will rise. So when we talk about earning distribution, we are talking about EPS, earning per share, which is directly impacted by the stock prices in the economy. Let's dive into it and read it in detail. Quantitative risk assessment tools are more complex. And over here, we are talking about first method, which is cash flow at risk. So cash flow at risk is used to estimate an organization or business unit change in cash flow received relative to targeted cash flow expected over a time horizon, which in our example was 5 years. Now, cash flow can be at risk due to many factors. For example, foreign currency exchange rate. For example, changes in GDP. For example, changes in supply and demand forces in the economy. For example, high-tech computer company is a computer manufacturer that uses a cash flow at risk technique to evaluate impact of foreign currency rates to assess foreign currency exchange rate risk. Similar to value at risk, probabilities are assigned and company computes the worst case scenario to be a negative cash flow of 1,000 or more. right? Now, if you look at this chart, at this diagram, what is happening? They have said that risk is cash flow less than 1000, which means cash flow less than 1000 is anything which is less than this amount. Now, if you look at this diagram, you will see that the highest probability is that you will earn somewhere between these two amounts. And you have equal probability of earning positive money and equal probability of not earning positive money. Also, they have written a line over here that at any given day, this probability of earning less than $1,000 is 5%. So if we look at this chart again, then we will say that this towards the negative side, this 5%, which is less than 1000, this curve represents what? This curve represents your less than 5% of variation. Moving ahead to earnings at risk. Earning at risk is the amount that accounting income may change due to change in interest rate. Now, how does interest rate changes our income? To understand this, let's look at the example. An organization purchased one available for sale security investment of 10 lakhs. 10% was the coupon rate, and term to maturity is 3 years, which means on this 10 lakh, you will get 10% rate. But if in the market, the rate is 11%, you are losing 1% every year, right? You're losing 1% every year. So how much you are losing every year? How much you are losing every year? 24. This is your earning at risk. Next is earnings distribution. Earning distribution is EPS. And we have said that EPS comes from stock prices, right? So let's look at this example, probability distribution. The Bleem Co. will issue its third quarter earning at the end of the week. The consensus is that EPS will be 1.55. Market analysis at Jacob Brokerage forecast the probability. What is the probability? 1.30 EPS has 15% probability. 1.50 EPS has 25%, and so on. We have to calculate weighted average EPS. Now, how to calculate weighted average? We will multiply each EPS with its probability. And we will add them up. So it comes down to 1.6. Right? And which in our table is close to 40%. So we say that since we have a consensus on 1.55 EPS, the highest probability is that the EPS will range from 1.55 to 1.65. Right? So we say that based on the probability distribution, both the weighted average EPS and most likely EPS is above 1.55. Weighted average EPS is 1.6, right? And if we look at 40%, it will be 1.65. If Jacob is correct in their estimate, the company will come in higher than expected and stock price should respond favorably, which means over here, we are not anticipating risk. We are not anticipating something which is negative. We are anticipating something which is positive. Why? Because as per our market calculation, it will come near to 1.65. All right. And then based on this, we can do our cost benefit analysis. Now, what is cost benefit analysis? See, if I will invest 10 lakh today, I will want that towards the end of the maturity life. Say if I invest 10 lakh today and maturity life is 3 years. So I will want that at the end of 3 years, I will get something extra over 10 lakh. These 10 lakh have to come back, but what extra am I earning? Right? So my cost is 10 lakh, my benefit is this. If my benefit is more than my cost, I will definitely invest. But if my benefit is less than cost, I will not invest. Therefore, cost benefit analysis is used to support resource allocation decision, such as equipment acquisition. Why? Because while buying the equipment, we ask ourselves, we analyze that if today I am investing 10 lakh rupees to buy the equipment, whose cost will be recovered at the end of the useful life? Then I have to think whether at the end of the useful life, the present value of my investment will be more or less. So whenever we do cost benefit analysis, we always look at present value or future value of the money. Let's look at the example. Analyzing cost and benefits. XYZ is considering an investment in equipment that will be used to digitize its records and to provide digitization services to other entities, resulting in annual income of 50,000. So whatever money I am investing today will give me an annual income. It is going to give me annual income of 50,000. Now, the need for maintenance on the equipment will escalate over the life of the project. And this is what we have anticipated. That if I today invest 1 lakh rupees or $1 lakh, then I will get 50,000 in year 1, 50,000 in year 2, and 50,000 in year 3 respectively. This is my fees that I will get. In addition to this, the efficiency will increase and I will get something additional, which is 2,000, 6,000 and 6,000. But what is my maintenance and training cost? 12,000, 9,000 and 12,000. So what is happening over here? That year 0, I am investing 1 lakh. Year 1, my benefit is 52. But my cost is 12 additional. Year 2, my benefit is 56. And my cost, additional cost is 9. And year 3, my benefit is again 56. And the cost, additional cost is 12. Now, due to this, what will happen? See, if today I will look at these values, I'm not doing the correct calculation. I have to look at their present values and future values. How are we going to look at it? By using the discount rates. They have said that training and maintenance costs are discounted at 8%. Year 1 fee and efficiency gain and year 2 fee are discounted at 10%. So what we are going to do? We are going to discount them. And how do we discount them? If the fee is 50,000 and I have to discount it 1 year for 10%, I will divide it by 1.10. Right? So this will come down to 50,000 divided by 1.1. It will be 4,554.54. So year 1 fee at 10%. Year 1 gain also at 10%. What was year 1 gain? 6,000 divided by 1.10. Sorry, 2,000. So again, you will say 2,000 divided by 1.1. It will be 18.88. So actually, this is not your benefit. Your benefit is 45,454 plus 18,18, which will give you 45, 4.54 plus 18, 18.18, which will give you 47,272, not 52. So what we will do, based on all these rates, we are going to discount them. And then we will get to know our actual benefit. Our actual present value of net benefit will be this, wherein our cost is 1 lakh. So our benefit is more than the cost. Therefore, we should definitely go for this investment. Understood, everyone? Guys, have you understood? Right. Chalo, moving towards the last leg of this chapter. Let's move towards the last leg of this chapter, which is capital adequacy and risk. Now, when we talk about capital adequacy, what do you understand by adequacy? What do you understand by the term adequacy? Can anyone tell me?
Sufficient.
Level of satisfaction? Okay. Sufficiency. Enough. Right. We mean that adequacy means sufficiency, which is enough. Right? This much amount is enough for my business. So when we talk about capital adequacy, we are looking at the financial resources required to operate and grow our business. So we say that capital adequacy is same as long-term solvency. Can someone tell me what do you understand by the term solvency? Guys, do you know what does solvency mean? Anyone? Liquidity. Okay. What
Ability
else?
to meet your long-term
Sufficient amount. Ability to pay the debt. Very good. Very good. Right. So solvency means that I have enough funds to meet my day-to-day operations, to meet my obligations. So when we talk about sufficient capital, we are basically talking about liquidity. Short-term operational goal of liquidity is to maintain sufficient resources to meet day-to-day obligations, like to pay our daily wages, to pay for daily transport expenses. That is short-term. Short-term liquidity can be addressed with line of credit, short-term financing, or reserves. Whereas when we talk about long-term solvency, we talk about reorganization or merger. So you need to remember this. Capital sufficiency is looked at two levels. Capital sufficiency is looked at two levels. One is short-term and another is long-term. When we look at short-term capital sufficiency, we look at line of credit. We look at unsecured loans, right? But when we talk about long-term, we talk about mergers, acquisitions. So over here, what we need to focus on is that capital adequacy is the measure to risk, to measure the risk that reasonable losses are so high as to make the bank insolvent and endanger depositor funds. So these are the two terms we are using in banking. And we are saying that capital adequacy measures the risk to be too high, that we do not have deposits in our funds. Now, the ratio measures the degree to which asset value needs to fall for reserve to be overwhelmed by liabilities. Capital adequacy ratio is computed as the ratio of capital and various reserves to outstanding loans weighted by risk factors. The higher the CAR, the lower is the risk of potential insolvency. If we will have high capital adequacy, our risk for insolvency will reduce, which means capital adequacy and risk are inversely proportionate. Okay. Now, the capital adequacy ratio adapts easily to the defensive posture of risk-averse financial institutions that must be unquestionably solvent and able to conduct business on behalf of depositors. The solvency ratio adapts more compatibility with business that are more willing to take risk. So there are two terms which we are using here. One term is risk averse and another is risk taker. When we talk about risk averse, we are talking about capital adequacy. And when we are talking about risk taker, we are talking about solvency ratio. Risk averse person is that person who proceeds in the business cautiously. And risk taker is the person who is bullish in nature, who is anticipating growth, and due to more growth, he or she is targeting that there will be more risk and they are ready to take on that risk. Because they believe that that will lead them to higher returns, which will eventually increase the value of their firm. Why? Because we have said if the risk is more, the anticipated return will also be more. Right? And this will increase the value of the firm. Fine. So this was all about this chapter of risk assessment. And in this chapter, I'll just quickly summarize what we have studied. All these things we are going to discuss tomorrow. This chart we are going to discuss tomorrow, not today. Today we have discussed only first 4 charts, wherein we have looked at different types of risks, which I am revising for you people: business, financial, strategic, operational, legal, compliance, political, inherent, and residual. If we talk about loss of profit, we are talking about business risk. If we talk about capitalization, transaction execution, and settlement, we are talking about financial risk. If we are talking about any event or threat in the industry which will not make me apply my strategies or which will make my strategies fail, I'm talking about strategic risk. Then we had operational risk from human error through which we cannot do our day-to-day operations. Legal risk, we have 3 things: failure to adapt changes in law, defective products, and breach of contract. Then we have compliance risk, political risk, inherent risk, and residual risk. In inherent risk, there is no direct or focused action by the management. And in residual risk, even after applying all the actions, there will be some sort of risk that will be pending. That will be your residual risk. Then we looked at the concept of volatility. And we said that if the time of the security outstanding is more, the volatility will be more. The probability of change in rate of return will also be more. This will lead to more risk, more loss. And we have looked at 3 types of losses. One is your unexpected loss, one is your expected loss, and third is your catastrophic loss. Expected loss is something that you budget for, which you anticipate. Catastrophic loss is something that you get insured from the third party. And unexpected loss means value at risk minus expected loss. Value at risk is nothing but worst case scenario loss. And to compute value at risk, we look at 3 things: historical, variance-covariance, and Monte Carlo simulation. Variance-covariance is a statistical measure, and Monte Carlo simulation is about hypothetical scenarios wherein we make projections. Then we studied about qualitative risk assessment tool and quantitative risk assessment tool. Under qualitative risk assessment tool, we looked at 3 things. One was risk identification, risk ranking, and risk mapping. Risk identification, we studied 5 things: risk inventories, facilitated workshops, interviews, questionnaires and surveys, process flow analysis. Under risk ranking, we looked at 2 things. One was probability and another was potential impact. Under risk mapping, we looked at graphical representation of risk ranking, under which we looked at likelihood and impact of risk by 2 ways. One was heat map and another was metrics. Yes, Sai, you will get these notes. Don't worry. These notes will be shared on the LMS after this session. Don't worry about it. And then we have quantitative risk assessment tools, guys, wherein we look at cash flows at risk, earnings at risk, and earning distribution. And then we talked about capital adequacy and sufficiency of capital. This was all about this topic. If you have any doubt in any concept, you can ask me. And if you don't have any doubt, we will stop the class here for today. And tomorrow would be an extensive class because tomorrow's topics are a bit complex and they are heavy on the theory part.
Yeah,
So,
Priyanka?
madam?
if you have any doubt, you can ask me. And if
Hello,
you have
madam?
no doubt, we can stop the class here.
Madam, can you hear me? Hello?
Hello, Priyanka, can you hear me?
Yes, Dilesh.
Tomorrow we're going to cover
Yes, I can show
enterprise
you the
risk
VAR
management.
slide again. Yes, Dilesh, you raised the hand. Do you have
Yeah.
the doubt?
Yeah, no,
You
tomorrow
can
we're going to cover
write your doubt in the
enterprise
chat
risk
box.
management.
Tomorrow, Dilesh, tomorrow. Yes, no, Jay, I cannot hear you. You can write your doubts in the chat box. Dilesh, tomorrow we are going to look at module 2, which is enterprise risk management part 2. Tomorrow we are going to look at Abhi, what we have done is we have understood what are the types of risk, how to assess them. Tomorrow we are going to look at the methods of managing the risk, how we are going to reduce the risk, how we are going to mitigate the risk, what to do if there is residual risk. All these things we are going to talk tomorrow. Are we covering example solving for exam perspective? Yes, Rakesh, we are definitely covering for exam perspective, but you really need to understand one thing. You are no more in school, you are no more in college. You are preparing for a professional exam. And whenever we talk about professional exams, we focus on concept clarity rather than digging into one question and looking at many variants of those questions. All right. Hazard risk is something which is not a risk. As I told Jay, hazard can become a risk. Okay. Pratishtha is saying, can we discuss the MCQ also from the Becker portal so that we can have more understanding? Yes, Pratishtha, definitely we can do that. Let's do one thing. Let's do it right now. So you have been given 3 MCQs at the end of this chapter, which we have studied today. Try solving that. Try solving those questions right now. I'm giving you 5 minutes to solve question number 1. Let's try solving these questions. Once you have solved the question, give me a thumbs up so that we can discuss. Have you solved first question? Guys? Yes. So were you able to solve first question? What is the answer? B, right. Operational risk. Why? What is the catch for this? There is machine malfunction. There is injury by slip and fall. So all these things are operational things, right? Solve second question. Quickly solve second question. Let's see if you people can solve second question. Let's solve this question together. So in this question, what is happening? There is a fleet of 10 cargo vessels. And the accounting division has estimated that ongoing maintenance of the fleet will cost approximately 5 lakh per year, right? So they have said that the maintenance cost is 5 lakh. So maintenance cost is 5 lakh. Replacement cost is 200 lakhs. Replacement cost is 200 lakhs. The company insures the vessels for 90% of their replacement cost. And whatever we insure is catastrophic, right? So 200 lakh into 90% will be catastrophic. And they have asked us what is the value of unexpected loss. So how are we going to tell? See, the value of the cargo vessel is 200 lakhs. Ma'am, how do you know this? See, replacement cost means if you will buy new, right? Which means that if you will buy new today, the cost will be 200 lakhs. And maintenance cost per vessel is 50,000. Per vessel is 50,000. So what will be the maintenance cost of one vessel? 50,000 is per year for 10 vessels. Sorry, 5 lakh is for 10 vessels. How much will be for one vessel? 50,000. So one vessel has a cost of 200 lakhs plus 50,000, right? Which will be 2,005,000. Now, catastrophic loss is something that you have insured, right? So how much have you insured out of it? How much you have insured? This is expected. You have insured 18 lakh. You have insured 18 lakh. This is your expected loss, which is maximum. That if you have to buy new vessel, your maximum cost would be this, right? So this is your maximum loss. Out of this, catastrophic loss is 18. Yes, that is why we have added. Shreyas, maintenance cost will be capitalized. That is why we have added 50,000 to the replacement cost. We have capitalized it. Why? Because, Acha, you are asking why? See, because it is periodic maintenance per vessel. See, we are talking about AMC over here, annual maintenance cost. So annual maintenance cost of 10 is 5 lakh. Of 1 will be 50,000. And why we are capitalizing it? Because if we will buy new for 200, immediately we have to invest more, which is 50,000. So out of our pocket, how much will go in one time? That will be your 200 lakh plus 50,000. That is why this will be your maximum possible loss. Out of this maximum possible loss, catastrophic is 18 lakhs. And every year you are expecting that out of my pocket, 5 lakh is going to go for 10, which is 50,000 for one. So what we are doing is, we are saying that if I buy new vessel today, first I have to bear its cost, which is 200 lakhs. Secondly, today itself, I will have to pay for its maintenance cost, which is 50,000. Okay? So this much amount is something that I will have to bear if I buy today. This will be my maximum loss, maximum possible loss. If I will not buy today, then what will happen? Maintenance is not sunk cost. It will be recovered when you will get return from it. If I not buy today, I have to pay my insurance, which is 18 lakhs, 180 lakhs, sorry, 180 lakh, 200 lakh ka 90%. I know that every year I have to pay maintenance, 50,000. This will be 18, 180,500, right? So what will be my unexpected loss? Unexpected loss will be 250 minus 18050. This will be your 2 lakh, which is your option D. Got it? Option D. Now quickly do question number 3. Quickly solve question number 3, everyone. Management of Able Corp is assessing and prioritizing the risk of to the achievement of return on investment objectives. Solve this question and tell me, what are you going to do? Are you going to develop risk inventory, conduct a facilitated workshop, develop a heat map, or develop a process flow analysis? What will you do? Why C? Why will you develop a heat map? You will develop a heat map because they have already identified the risk for you. They've already said that there will be declining profitability. There would be unexpected losses from asset destruction, fraud. There would be scenarios where return on investment will not be achieved. So all these things are already identified for you. All these things are already risk identifications, right? Therefore, what will be our next step? Our next step would be risk ranking and risk mapping. But in the options given to us, there is no risk ranking. There is only risk mapping and identification. Since the identification is already done in the question, we are going to develop risk map. And the option would be option C. Absolutely right. So now you have understood that the questions could be practical as well as theoretical from this topic. And you have solved these questions by yourself. I haven't helped you. So do solve more questions from the Becker portal. And if you have any doubt, you can ask me. You can, just write down your doubts and send it to me, because there are so many questions, so many MCQs in Becker's portal, and it is not possible to discuss each and every question. So I will say that if you find any problem to solve questions on the Becker portal, solution number 1, look at the solution video. Solution number 2, you can ask me, no problem. How you are going to ask me? You can provide the list of your doubts to Simandhar team, and they can communicate it to me, and then I can address those doubts in the class. All right. Becker has solution videos and question answer explanation. So whenever you try to solve any MCQ, there is a solution explanation given along with the question, and that is detailed. So you can always read that to get the solution. And still, if you don't get the solution, then you can ask me. I'll explain second question again. In second question, you have to look at two scenarios. One is that if you buy the vessel today, what will the cost that you will have to bear? You will have to bear the purchase price, plus you will have to bear the maintenance. This will add up to 250. Because the purchase price is 200 lakhs and maintenance cost per vessel, not to the cargo, not for the fleet. We are talking about per vessel. Per vessel will be 50,000. Right? But if you don't buy, still you will have to meet the insurance, which is 90% of your replacement cost, which will be 180 lakh. Still you will have to meet the maintenance, which is what? 50,000. You can also say that maintenance is irrespective of whether you buy or you don't buy. So you can ignore this as well. And if you will ignore it, the confusion would only be between your purchase cost and your insurance. So your unexpected loss would be 200 lakh minus 180 lakh, which will be your 2 lakh. Okay, how to do self-study? To do the self-study, there are 3 parameters. First, watch all the Becker videos. Watch all the lectures. Read the notes. And third, solve questions. Solve questions again and again. Take mock tests. So what I used to do was that if I have studied first unit today, I will solve its MCQs. Tomorrow I'll study second unit. I will solve its MCQs and I will take a small mock test of say 20 questions or 30 questions or 50 questions of unit 1 and unit 2. Why? Because this is cumulative revision. I always focus on cumulative revision. You should always do cumulative revision. What you have studied yesterday should be revised today. What you have studied today should also be revised today. What will happen that you will not forget what you have studied previously. And if you'll keep on revising it again and again, then that is going to register in your mind automatically. So the only key for self-study is cumulative revision. If you can develop the habit of cumulative revision, it will be better. And Becker's is a very extensive self-study platform. You have numerous MCQs, you have so many mock test papers, you have the liberty to create your own mock test paper by choosing multiple units. Say, for example, out of unit 4, there are, say in unit 4, there are 4 chapters. But you know that one chapter is your strength and other 3 chapters are your weaknesses. So you can always, design multiple mock test papers for these 3 chapters. The only key is to keep solving mock test papers and keep revising on daily basis. Right. Anyone wants to ask anything else? Any other questions? Yes, Gauri.
Hello, madam. Can you hear me, Priyanka?
You will have to write down in the chat box. I cannot listen to what you will say. So write down your query in the chat box. I'm listening first part 2 and not part 1. Gauri, I haven't understood what you are trying to say. I'm listening. Okay. You mean part 2 of module 4 of unit 4? Are you trying to say that you are first looking at module 2 of unit 4 and not module 1 of unit 4? If that is the case, I will sincerely advise that follow the flow of the lecture. There's a reason why the study material is in certain sequence. Respect that sequence and study in that sequence only. At least do not, you can shuffle between the units. Like you can take up the last unit first, no problem. But within the unit, try not to shuffle the chapters. Okay, part 1 and part 2. No, there is you can definitely take up part 2 first and then take up part 1. No problem in that. These are 2 individual parts. Surbhi, it is your choice that you want to watch video lecture from both Becker and Simandhar. If you have time and energy, I will suggest watch both. What will happen is first you will watch the lecture from Becker's. And when you will watch our classes from Simandhar, that will be sealed because you have listened to the same thing twice. You have solved the same questions or same examples twice. So it's like making your foundation strong. Do this if you have time. And Siddharth is asking motivation nahi aa rahi hai padhne ki koi suggestion. Siddharth, the motivation is a very personal thing. I mean, I can motivate you probably during my lectures. You will feel motivated. I'll only say that even if you have felt motivated for 5 minutes or 10 minutes by listening to someone or by reading something, that is the time when you are high on your energy. And if you could immediately open up your lectures and books and sit to study, that will definitely help you. Because motivation is only needed to open up the books. Once the books are open and once you are into the study mode, then you don't need the motivation. Then your study journey will be on the auto mode. We always need motivation only to kickstart. And this is what I follow. If I listen to any teacher, any mentor, or maybe my friends have motivated me to study, my family has motivated me, some podcast has motivated me, then I don't let those 5, 10, 15, 20 minutes pass by. I immediately open up my books and start studying. If I'm not in a situation to open up my lectures or book, at least I start revising the concepts which I have studied within my brain. So this is something which you can, practice. Eventually what will happen that the studies will start moving subconsciously in your mind, and it will take less time for you to go back to your books. So this is something which helped me, and probably it can help you. I completed my CA in May 2016. And I completed US CPA last year in September. This video will be saved in Simandhar's LMS probably by the end of day. For such technical questions, I think Simandhar team is the right person to talk to, but I believe that these lectures will be in the LMS along with my handwritten charts by the end of the day. So you can revise them again from there. As many as possible. There is no limit to it. I remember I used to solve 50, 80 test papers every day before sleeping, because Becker's is also, accessible on your mobile phone. You can download the app and you can access it on your mobile phone as well. So even if I was traveling, even if I was going out with my friends for movie or coffee, for break, I used to solve a test paper of 20 questions or 30 questions, just to revise what I have studied till now, till the end of the day. So these are some small practices which, if you can indulge into, you can really see good results. They have helped me a lot. What will be the future of US CMA and US CPA in India? The future is bright, because the workforce abroad is not very efficient. So they are outsourcing a lot of work in India, India being the youth capital, right? 75% is the passing marks. You have to score 75% marks in the exam to clear the exam. And I've discussed all these things in the orientation video as well. Under in the MCQ section, you have to score at least 50%. Then only your essays will unlock. And as regards the future of CPA and CMA in India, the future is bright. You are on the right track. You just need to study, focus on study, and take this degree. That's it. The profile, you can go for fund accounting, you can go for management accounting, you can go for cost accounting. All these profiles are open after CMA. As far as I am concerned, 75% is the pass percentage. If there is any change in the pass percentage, then even I have to check. But as far as my knowledge is concerned, it is 75%. For this, you will have to talk to Simandhar team. I'm just a faculty at Simandhar team. Regarding the experience, regarding the technicalities, you have to talk to them. Salary expectation depends that in what kind of industry you are and what kind of firm you are targeting. Yes, master Excel, try studying Power BI, try getting indulged into AI, how to use AI in Excel, because whatever degree you possess, ultimately you have to work in Microsoft Sheets. So if you're asking me what are the skills you need to, have, Power BI is something which fund accounting is looking at. You have to look at creating spreadsheets, all those advanced Excel functions like index functions, match functions, all these things. If you are well equipped with, it will help you to, be more efficient and effective in your work. It's like you people are interviewing me. I'm getting a feeling that I'm sitting at some interview. How to be better in essay type questions? Are there any specific areas where they are tested? See, when we are talking about professional exams, right, everything is important. Every area can be tested upon as an MCQ as well as essay. So whatever you are studying, please have conceptual clarity. And everything is important. You can't leave a single page from your study material. Yes, to practice for this, Becker's is the master of it. You should not look at any other thing other than Becker. Ma'am, suppose if we didn't get job in US-based company, then will it benefit us in Indian-based companies? Yes, because US CMA and Indian CMA have a memorandum, and you have many bright opportunities in Indian firms as well. So that is not going to be any problem. Yes. These were the skills I was talking about, right? All right, so that's it for today. And we'll meet tomorrow, same time, 1 p.m. And we'll be studying the part 2 of enterprise risk management. My only request is that if you can, study it beforehand, that will be a boon for you, because when I'll be taking you through this chapter, it will be easy for you to capture what I'll be saying, to retain what I'll be saying. And it would be easy for you to apply that to the questions which we will be solving. So try to revise what we have studied today and try to also quickly go through what we are going to study tomorrow. Okay, Siddharth, it totally depends on you, how much you can manage. See, when I was doing CPA, I was also working, and but my work was not very time consuming. I mean, I had leverage as well as privilege to take offs, and I had ample support from my office staff. So it entirely depends where you are working, what kind of support you are getting from people around you. What I'll suggest is that since you have already started to study and you are not working right now, then don't think about working also. Give your 2 months, 3 months full focus and full dedication towards study. Clear the exams, and after that, full life you have to study. You have to work only. Don't divide your energies at two places which need equal and equal focus and equal time. Because if you start working now, then your organization will expect you to invest time, right? which you won't be having because you have to study. So I'll suggest just study. Take 2 months, 3 months, clear the exam, and then you will be ready to work. And you will get better opportunities also, if you will have the degree. So this is my suggestion since you have asked, but it's always your personal choice. All right. All other questions will be taken up tomorrow. Whenever I say all right, we'll meet tomorrow, you have a question. Okay, this is the last question which I'll be addressing today. The question is, what are your suggestions for working professionals? So Jaipal, I also was a working professional when I was studying. And I think I've already shared this thing in my orientation class as well. Start your day early. Try to wake up early, 1 hour, 2 hours. Try to utilize that time to study. Start your day with studying, end your day with study. And if you get any opportunity, any leave, any holiday, any opportunity wherein the days are not very heavy on work, utilize them to study. If you are a working professional, then you cannot think about any third thing other than your work and your studies. This is what you have to do. You have no other choice. So if you wake up, usually you wake up at 7 a.m., start waking up at 5 a.m. Give those 2 hours to your study, continue with your routine. And when you come back home, then also you have to revise what you have studied. And weekends पे भूल जाओ कि तुम कहीं जा सकते हो. No marriage, no party, no function. Yes, you can take breaks in between, but you have to be self-disciplined because over here in this case, your energies are being utilized at 2 different places. So if you are already a working professional, the journey is going to be difficult because you have to manage 2 things all together, but it is not impossible. If I can do it, even you can do it. Anyone can do it. It's just that your goal should be clear. All right, Jaipal, Siddharth, Palakpreet, Shreyas, I hope I have answered all your questions. Cool. So I'll see you all tomorrow. Keep studying. Keep noting down your doubts. You can ask your doubts tomorrow. Sure, Neeraj, you can ask your questions tomorrow. No worries. All right, bye. Bye-bye, everyone.